Welcome back to the New York City Multifamily Podcast, Q4 2023 update. I'm here with my esteemed colleague, Seth Glasser, Joey, One Cap Koicim. We'll talk about that later. And Mike Millions Salvatico. Welcome to the pod, guys.
Welcome, Mike.
Thank you.
So just to set the tone a little bit.
Thank you for that.
Thank you. Just to set the tone a little bit, we started this podcast 90 days ago with our Q3 update, and a lot has changed in the world over that last 90 days, and we're going to dive into some of those changes. But I did think, as far as how much turbulence is in the marketplace, I'd plug us, one time quickly, because we put $244 million worth of property under contract or closed just within the last 60 days. And I'm reading through a little bit of the food groups here, and we have 3 Manhattan portfolios that involved interest-only financing, a big theme that is selling today.
Attractive debt at 3.5%.
A fully rent-regulated $50 million portfolio in Queens, a 58-unit on East 12th Street in the city, a development site on South 6th Street asking $20 million, 2 core plus opportunities in Brownstone, Brooklyn on Montague and Pacific Street, both trading around a 6% cap on cost, and a couple fully rent-regulated portfolios in the Bronx. We'll touch on what the metrics look like there, 3 condo conversions in Park Slope, and a couple random land pieces. So that's what makes up $244 million. If I could point to any theme in that, it's what's not there is the hybrid, partially free market, partially rent stabilized. It's either all rent stabilized or all free market or developable into free market. But Joe, why don't we start with you? You actually account for the majority of this 244, so congrats to you. What are you picking up on in terms of what investors are looking for with these assumable loan portfolios? Why are they attractive? Why are they liquid?
Well, I think the big thing that we're seeing is obviously with rates moving so much in the last 30 days or 2 weeks, right? The Treasury went from 10-year Treasury went from 4 to almost 5 in the last 10 days. Everyone that is buying right now is looking for some type of yield. And we had a couple of portfolios that we had a lot of interest in because the assumable debt was at 3.7% for interest only for 5 years. So
what was the cash on cash? What's the cash on cash return that gets people out of bed?
So on brokers' numbers, north of 10. On real numbers, it's probably 10%.
Right.
That's double-digit cash on cash returns for 80% free market buildings downtown in the East Village.
Right. So Warren Buffett used to always say this. He said, what rate of return are you looking for? He said, twice the risk-free rate. So if the risk-free rate is 5%, if you can get into double-digit cash-on-cash returns, you don't need upside. You just need stability. So that's a predominant theme. If you're out there and you have loan docs that really allow for a loan assumption, we can likely replace you with a better borrower that will be okay with the bank, and this is how you can get some deals sold.
And there's a lot of doom and gloom out there, but there's a lot of buyers that are still getting aggressive. And like who the buyers are today, like one of the assets, one of the portfolios went to a foreign group. One went to a local syndicator who had a high net worth investor who wanted some losses for depreciation, and there was high leverage on the loan. So there's different reasons why people are buying, other reasons why people are selling today. And we have another portfolio out on the market for $100 million with $75 million of debt.
So let's talk about this for a second with the assumable debt, because that's kind of like its own category. Because we have a lot of clients who want to sell, and they're like, "Oh, I have this debt, from a few years ago. It's so much cheaper than it is today. Like, why don't you go try to sell it?" What are the types of loan terms and rates that are getting people interested? Like, if you have 2 years left on the loan at 4%,
that's challenging.
Yeah. So you need 4 or 5 years left on the loan.
Yeah, I would say minimum 5 years, 4 or 5 years, like you mentioned, Seth. But the biggest issue is, how some of these groups are underwriting it and being conservative on their numbers. In 5 years or 4 years, debt comes due. What are they assuming for the interest rates? Right. So I don't know. Do you have a crystal ball, Mike?
I think that what I'm hearing all over the place is that most buyers are assuming that the rates are going to stay like this for at least 2 to 3 years. And that's basically been the consensus. I think 6 months ago, people were like, oh, end of 24. Now people are assuming into 25, we're going to be at this level or higher.
Sean, do you
well,
take on the risk of assuming debt for 3-4 years?
4 or 5 years I'd be comfortable with. Those portfolios you have in contract were 2030 maturity, so that gives you plenty of time. I mean, I personally think that the recession is coming faster than we think, and I think that we in
Why
New
are you
York City,
smiling when you say that?
because New York City real estate has already been in its own micro recession because of all regulations. So the quicker there's a national recession, the quicker they're going to lower the interest rates and give us some reprieve.
Yeah.
So I'm kind of hoping for a hard landing faster.
Well,
I don't want 7%.
Yeah, you just want it over with. And
You want some certainty.
If you look at the last couple of recessions, the interest rates went up like pretty slowly, and then they came down really fast.
Correct.
To compensate for that.
That's probably what's going to happen.
And that's the opposite of what's happened in the last 18 months. The interest rates have gone up really fast, and it's kind of hard to tell how quickly they're going to eventually come back.
What do you
down.
think happens to pricing though if rates come down quick? Is price going to go up? Because it's going to be a negative if price.
I think you're going to have.
Economy.
I think it's going to depend. Yeah. It's going to be really, really nuanced, kind of like it is right now, where like the hybrids aren't selling. I think that kind of stays the same generally moving forward.
Yeah.
I think the fully stabilized stuff continues to sell. The cheaper the basis, the better the location. You'll do fine.
Yeah.
And the free market rents, I think, will kind of go in lockstep with rates and kind of where the rental market is at any given time.
Let's talk about the rental market right now, because the one thing that's really going in our favor in New York is rents are still moving up, and everywhere else around the country, that's not the case. So, everyone that fled New York to go buy yield in the Sun Belt and Midwest are starting to come back, seeing the fundamentals of rent growth in New York City. Obviously, you got regulations, and we had some news this week with the Supreme Court not picking up the case with the rent laws, which we could touch upon. I think that's creating some certainty from some owners right now who are on the fence of potentially selling. And now that there's less hope that things are going to change in New York City as it relates to regulations, you're going to see more velocity. Does anyone agree with me there?
I think that rents, overall, we're seeing rents are down 10%, since summer.
Down 10% off the high.
Off the high, exactly.
But nationally,
primo, right?
Yes.
In the locations where the rents went the highest, there's probably you're giving a little bit
it's
back,
seasonal
right?
too. It's a little bit seasonal too. So.
But to your point about what's the effect of the Supreme Court, so we're speaking today. It's 2 days after the Supreme Court decided that they're not going to pick up the Chip versus NYC case. There's still 2 other cases outstanding. I don't think any of the buyers that were buying 100% rent regulated buildings 30 days ago were betting on a Supreme Court win.
Agreed.
But I do believe that a lot of sellers that were holding out for this one little last piece of hope before selling are now have the conclusion that they were looking for, and knowing that it's unlikely we're going to have meaningful change on the rent regulated side, and it's unlikely that interest rates are going to meaningfully drop in the next 18 to 24 months. So the question is, are you ready to stay wed to this building or this type of lifestyle for 3 to 5 more years? And we're starting to sense that the answer to that question is no, especially when you can sell capital gains or not and reinvest into a risk-free 5.5% return. You can actually get yield by just getting cash to work.
Yeah. The alternative investments are becoming more and more attractive and more attainable. So I think more people are going to continue to look for that type of opportunity. And remember, it takes people 6 months to actually process, understand, accept, right? the 12 stages of grief, right?
Which stage are we in
step
right
one,
now?
what stage are we in right now? You just acknowledge just what it is.
Yeah.
And remember June 2019 happened, and then the rest of the year was kind of quiet.
A little bit of a pause.
Little pause, processing, grievance.
Yeah.
And then 2020, we had a really big year. All these people were screw it.
And then there was a window with rates, right?
There was the window with rates.
So Seth, where is pricing? Carpenter Ave portfolio, Thayer Street, West 111th. Who's buying in the Bronx, Uptown Manhattan? What's the new Albanian group that's doing?
The fully stabilized buildings are the pricing is really nuanced depending on the address and the quality of the building and the basis. So this is all
lowest cap, highest cap.
So what's the first metric when you call and pitch somebody a deal? What is the first question they ask you? Price per door, GRM? What do they ask you?
They're typically asking price per unit.
Price per unit.
I would say price per unit's number one.
Basis.
You can't in my opinion, bring a building out to market right now that's fully stabilized more than maximum 7.5 times the rent on the asking price, because you're kind of just like not even giving yourself an opportunity. But once you're priced in that 7.5x or below, as long as the building's not in like AEP or some type of like really crappy location, you're going to get eyeballs on it. If it's a good building in a good location at a 7 multiple and less than 130 a door in Manhattan and less than like 125 a door in the Bronx, you're going to get eyeballs on
And what
it.
are those close to 7 caps?
And those are basically 7 caps. The deal on Carpenter Avenue, this was an estate sale that we put under contract. This was a little bit of a mess, so it's not really apples to apples. This went for like 75, 80K a door, because it was just
High violations.
under the hood.
Right.
This was like, this had some
you needed
serious
50 a unit. to get
yeah,
that.
like the elevator was down, the paperwork, estate sale, like everything that goes along with, nobody like checking in on the building like every day. It requires like a little bit of maintenance on that stuff. And the rents were low.
Yeah.
Like the rents were just like stupid low. And anything like I don't know if you guys remember, but every year when the RGB votes on the rental increases, they put together like a survey of the costs, what it takes to run these buildings for the previous year. And if the average rent in the building isn't like $1,400 a month, you lose money before a mortgage. Like forget about paying debt service, but the cost to run the buildings are basically $1,400 per unit. So buildings, that's kind of like the divide almost, where if your average rent in the building is below $1,400, you're almost like in like one bucket. And then if you've got a higher average rent, you actually could make money, and you're compounding 3% increases on $1,800 look a lot better than compounding at $1,200.
That's 100% what we're seeing. I mean,
Yeah.
even the small buildings in Brooklyn, if you don't have rents above 1,500, it's very, very tough to sell.
Yeah.
Above 1,500, we just brought a building out on Troutman. We had 7-8 offers within.
I think
days,
also
so.
like it's kind of funny just noticing this, like the tenants that pay the least ask for the most.
100%. That's always been the case.
Those right, so it's almost
and they feel like they own the building.
numbers are one thing, but also you're like, oh, like all these units with like $900 rents, like these people are going to be paid in my ass,
Yeah.
And operation costs continue to rise.
For sure.
Are the profile of the buyer different today than it was a year ago? Like different types of buyers coming to the Bronx, heavy stabilized buildings?
Well, there's no hot shot.
Not-
There.
Not really. I mean, it's not like it was, before 2019 where you had 20% of the market buying 80% of the buildings. It's not like that. It's a little bit more spread out where, this guy takes one, that guy takes one, and maybe you have, it's just more of it's a bigger buyer pool in a weird way. And I kind of biting my tongue saying that, because there's not like there's hundreds of buyers for these fully rent stabilized buildings, but like if the location is good, if the bricks are cheap and the building is clean, there's a buyer for it.
Yeah, and there's more buyers dipping their toe in, even with everything going on. I got a email literally a day after the Supreme Court didn't pick up the case. Group out of DC, they're like, they don't own any properties in New York. We want to buy rent stabilized buildings in Manhattan. Yeah, it was just a interesting timing of an email.
They probably looking at this like some crazy opportunity, like, oh, I can get an 8 cap.
Yeah.
Well, it's to your point. There's a cycling out of the growth markets back to the highly imbalanced supply demand markets, the regulatory markets in DC, Boston, New York City, because there's no growth anymore in this.
And we're seeing the same thing out of Germany, right? So some of the groups that we just sold downtown to are German investors who, I think their cost of capital is different, and they're coming in and getting aggressive, buying all cash, and hoping
more
down the road.
restrictive.
Yeah, they're coming
They're
from an environment
way more
with
restrictive.
actually stricter rent regulations,
Multiple year
in
rent
New York
freezes
and lower cap rates.
What about development, Mike? What do you see on the development front?
I mean,
that's another category that's bucking the general trend, I would say, in the prime markets.
Yeah, I think the prime markets, there's very much still demand, for these development sites. I think specifically the smaller development sites, call it the 25 by 100, you can build a tax-less 2A to 2B building. Those are very much in demand. I think a lot of people get worried that with 421A, nobody was going to buy, but people were still paying 400, 425, 500 a buildable in these prime markets.
So we're getting land sold in Williamsburg and Greenpoint at a higher price per buildable than many areas of Manhattan.
Yeah.
And also anything that's a 5-unit or under building or a fully vacant building. One of the ones we just sold is on 6th Avenue, sold for $3.2 million, $700 a foot. If basically the sellout on the condos is twice the vacant shell price on an existing building, you're in the money. So that's one of my quick, bumper sticker, just ways of highlighting anything.
So smaller land deals are selling.
Yeah, and
smaller buildings are selling with tax class protected, right? Anyone, it's scared of regulations or looking at 5 units and under now. Like, some bigger groups, right? Like we know some of the bigger names that are only buying, and they're buying at $1,700 a foot.
People are seeing the exits, right? People are seeing that you can sell out these tax class 2A, 2B buildings fully done at a 5 cap, 5.5 cap. So you can see an exit, you'll buy and build.
But why are they buying at 5.5 cap when rates are at 6.5?
Usually exchanges, because again, they don't want to take their chances in the growth markets because they're New York City people. And then when they're in an exchange, they're more worried about the regulation and the unknowns of hurrying into a deal that they can't properly diligence. So they gravitate to what's brand newly renovated, 5 units and under, so I don't need to call down the attorney and just get my whole, the whole what could go wrong scenario. And ideally, the combination of those two things is worth. So it's basically what is being able to sleep at night worth? It's worth 150 to 200 basis points.
But you're seeing institutional capital also. Wait, but hold on, Shaun.
More to me.
But Shaun,
I love sleeping.
Institutional capital is still buying these, smaller buildings, and they're not exchanging. So why are they?
So that theory is the whole supply-demand imbalance that you just can't create more free market apartments right now. So in general, they're just going to, the rents will keep lifting, and there will be a cap rate compression on that category for the same reason.
That's also asset allocation, I think, right? Like 10% of the cash goes here, 20% goes there. They're kind of spreading it around. But that's interesting that there's so much development happening in Brooklyn, and I wonder if that impacts the rents a few years from now.
For sure. I think there's not enough
supply
being built, and I think some of the smartest guys that we're selling to, some of the biggest owners in Brooklyn, they're buying all cash, they're closing 2 days, 7 days, these type of deals, because they know there's not enough units.
So we should be working Brooklyn too.
There's not enough.
Grass is always greener.
There's not enough units being built, and they believe that when these buildings are finished in 2 to 3 years, that the rents are going to be premiums.
So these are like little, they're 25, 30 footers, right?
No. Like when we talk about small, we're talking about like under 50,000 buildable space.
Yeah, but even the smaller ones.
But are these owned by a lot of private client, like long term? So what are those sellers?
Running their business out of the van.
What are they doing?
So those sellers are
they're buying net lease. They're buying net lease.
Those sellers.
Oh my God, these flip phones. Where do you get a flip phone?
If I see a client with a flip phone, I know he's got deep pockets.
100%.
StarTech.
And those sellers in general are actually in the best position because all their value's in the air. So they can sell, and now cap rates are elevated on all the exchange properties, so it's a perfect thing.
But are they buying the rent stabilized product, or are they going?
They're buying finished product. Yeah. So like one of our sellers in Williamsburg, he's going to buy finished product mixed use buildings at 6.25 caps. And it's a win-win because he sold a building that wasn't making any money.
Yeah, we could sell him a few. We're putting three 2B buildings in contract on the west side of Manhattan today at a 6.5 cap.
He only wants prime neighborhoods, though.
And
That's pretty prime.
This is also what I want to keep the listeners to a cue on. In every single recession and recovery, multifamily bounces back the fastest. So to your question of how quickly will they lower rates, my opinion is they lower them faster than they raise them, actually, because we're going to hit some seminal moment. Stock market drops, everyone's panic at the disco, and they're going to have to make a meaningful change to keep everything calm. Just kind of like the COVID response, right? Oh my God, no one can come to to work. Let's just funnel a ton of money at people.
But then there was a light switch that went on. Are we going to see the same light switch in terms of sales velocity?
I think we will, because our rents are going to stay high. In other markets, the recession is going to cause unemployment and rents are going to go down. Our rents are going to stay high, and the only thing that we have trouble with right now is regulation and high interest rates. So that part of things will.
But that's temporary, guys.
And also, multifamily bounces back the fastest in every recovery. So you'll see the cap rate compression happen fastest in multifamily. It's been the same way in every single recovery.
But everyone still calls us, wants the distress situation,
distress is here, guys. 7% cap rate is distress. So if you're thinking that it's going to go to 9 caps and you're going to be able to get a 200 basis point spread over the cost of debt, it's not going to happen. You got to be comfortable buying unlevered and buying the best quality 6 to 7 caps you can. That is
there's enough people in our market to buy property to catch the falling knife before somebody else will, right?
Correct.
Like it's never going to get to a 9 cap or anything like that.
I mean, some will, but
but like
there's certain situations.
They're not in the East Village.
No, not anything you would actually want to buy, or like where the the risk isn't factored in.
That's when foreign groups come in that are used to buying 5 caps in Europe. They'll come here and start snatching.
Which
up
we're
the
starting to
7
see
caps.
already.
Yeah,
right?
exactly.
You know what we haven't
Yeah.
seen? We haven't seen a new fund, like the true fund style of like I have 250 million and we're just going to cut checks for every property, refinance later. We have all cash purchases, but there hasn't been the groups formed yet, which are probably coming. The new 5 to 15 funds that are like, we're going to plant a big flag, we're going to do it quietly, and we're going to buy everything all cash and then refinance later. And they're coming.
The
I think they're
new
scared.
Swedish group that came a couple years ago,
Yes.
someone like
this.
that.
Yeah.
Yes.
They're scared, and those people don't want to get fired for doing something wrong.
I think you're going to start to see a whole. There's always somewhere in the world that's making money. They're going to find their way to the general partners.
Well, you're saying you're going to see somebody making a bigger bet.
Yes, bigger bets.
And I think that's starting to happen, and seeing how the signature loan portfolio plays out is going to be interesting in the next 30 days.
Right. So what are we hearing there? Are we hearing that there's going to be a lot of workouts or a lot of forced sales? It's still up in the
I think
air.
it's too early to tell, but I think there's a lot more certainty and easier to underwrite the regulated product versus the free market product for obvious reasons.
Mm-hmm.
And I think everyone was nervous that no one was going to bid on the stabilized product, but I think that's the easiest to underwrite, and that's going to be the most saleable today.
But so the FDIC, from my understanding, is going to finance both portions, both the debt and the equity.
Not necessarily finance. They're going to partner with an operator to help that.
They're basically looking for a property manager.
They're basically
Asset manager,
they're looking
really.
for an asset manager, and they're going to put so much subsidy behind this sale that it's not going to sell at 50 cents on the dollar. It'll sell much closer to par as a result of their support. So there's not going to be really much room for crazy cheap like flips, like flipping out of it. Does that make sense?
No, it does. And the government is going to control how the process goes. And they're not, these operators that are trying to buy the loans are not going to be able to get to the real estate.
The government wants there to be workouts. I don't want there to be workouts. I want there to be forced sales.
It wants to be sales, yeah.
But
wonder
that
why.
looks like that's the predominant way that the FDIC would like things to be attempted to be handled, is to go to the existing borrower, figure out if they have the ability to repay globally, get a resized loan if that's what it takes, but the recovery would also would have to go through the modification standpoint first. Now, where we are seeing a lot of friction, and I'm curious your take on the forced sales in the marketplace. There's a big difference in how lenders are treating borrowers if they have recourse or non-recourse.
Oh, yeah.
And we are seeing sellers that have maybe a $10 million loan outstanding, whereas before, if the property wasn't worth 10, I wouldn't even bother with my time. They're actually coming back to us and saying, can you get an offer at 9? Let me see what I can work out. Because
the lenders are starting to work out.
The PGs are PGs.
Yeah.
And they got to.
But most of the loans in the market don't have PGs, but those are.
There are some loans out
there's
there
more
with
than
some
you
of these
think.
debt funds that have partial recourse, that we sold a few recently, where the lender ended up taking a little bit of a haircut because knowing what's down the road and more distress coming, and wanted to get out in front of it.
Are you
Right.
seeing lenders forcing people to do it now, though?
I think they're
more
forcing
so.
the hand, but not publicly.
Got it.
That's kind of what I've noticed.
I think we'll see that play out over the next 6 months. I think that there's a little game of chicken going on right now with what's the value of the property, how much should I take a haircut. That's where we can come in. If you're out there, we can run a transparent process. We'll take the risk with our time, but we will deliver top of the market pricing, and you can decide with your lender whether to take it or not.
This is I 100% agree with you, and we've talked about this. Like, how do you preserve the most equity from the lender's perspective and the borrower's perspective? Because there's kind of a few options, right? The lender can go try to sell the note at a pretty decent discount, right?
Yeah.
Because the buyer of the note is kind of going in blind. What's the paperwork? Do I know the borrower?
It will be
Will he
less
give me
than
the
what
keys?
we can get them.
Right? It'll be less, right?
sure.
Or you can try to sell the building, but maybe that requires also a pretty big chunk of pay down from the bank's perspective to get out of it.
Well, remember,
and
the lender,
what is less?
the lender does not want to control the asset. take
Correct.
the
They
asset,
can
right?
take the asset back.
Because then they had to pay double transfer tax, which we learned the last episode. And that's not where they want to go with it. So they're going to have to take a haircut potentially. It just been like, it's kind of,
It's a game played in the shadows because they don't want to be out there saying we'll take haircuts on loans, and it's all playing out. I think because look, rates. When we had this episode 90 days ago, 5.5% to 6%. We are now in the 7%, plus territory. So hopefully we're going to start to even out and people can make rational decisions. It's very hard to work against a wildly moving market.
But one thing that also came into play now is the agencies are starting to get, obviously they're a little bit more aggressive, right? Aggressive but conservative in the same, but their rates are a little bit lower. So you're starting to see more of the agency takeouts, and I think that's going to play out specifically as it relates to the loan portfolio sale that we're just talking about.
Well, okay, so let's say the Signature Bank portfolio sells, and if I'm a borrower with a note that just sold, I have a $10 million loan and it's owned by somebody else, and they come to me and say, hey, can you go refi me out so I can make my spread? So now, okay, I got to go to a new bank and get a new loan. So let's talk about what the lending market is like right now. And from my understanding, once you get above 65% LTV, the competition in the lending market really thins out.
You're correct.
So
there's less savings banks.
Refi out people that are over leveraged if there's no.
Well, that's why you're seeing cash in refis,
right? It's really thin. But anything below 60%, I think there's a lot of lenders out there who are trying to look to.
And then there's this
idea.
rescue capital, right? Everyone's talking about the rescue capital.
The rescue capital, if the normal capital is 7%, what is rescue capital?
A lot more.
So who could afford to pay rescue capital if you can't even pay?
But their alternative is what?
Nothing.
Give the keys back. Take it.
And that's probably what's going to happen in certain situations. Some people are going to take the gamble and try to take some rescue capital at higher rates to try to hold on. Versus just putting more money in.
Conversations have gotten mature enough where no one's that conversation has to play out. Hey bank, here's the keys. Oh, I didn't think he was actually going to give me the keys. I don't want the keys.
Yeah.
Well,
it's also,
yes, here are the keys. No, I don't want it. And they have to flush through their options and really understand.
And everyone's exploring different options.
And, what they can actually do.
Yeah. I'm also seeing some owners recapping their current investors at lower values and resetting their promotes and moving forward that way. Wow. That's not happening in every situation. And it's not great to their LP, but the LP doesn't want to fund the capital call.
Yeah.
So
they're basically, hold on, let's stick with this.
Yeah.
They're diluting
that is a wiper.
The current equity, and through that dilution, there's a new basis. And if they're the ones that are coming up, if the GP is the one that quote unquote sourced the capital, there's a new promote level that's reset. So this is basically the GP providing the rescue capital and resizing everything
with a new equity partner that's providing it. Yes.
So there's a lot of friction between GPs and LPs. The era of easy fundraising is over. I look at some of the things I've invested into in the last 2 years. I would not do that today. Everything was in your favor before. Everything seemed like it was
up,
good.
up.
Yes.
Everything was going up.
It was hard to make a mistake, but the LPs are the ones that are getting squeezed the hardest and wiped
or they're the ones that actually put the real money in.
Everyone's asking, where's the money? Where's the accounting?
Where's the money? The money's gone. The money doesn't exist.
Yeah.
And so rather than putting more money into the deal for a capital call, they're choosing to just get their equity wiped.
Yeah.
And then the GP can go make another fee, go raise money from a different investor at a lower basis, and just keep going.
Some investors have a lot of tough decisions to make, especially with debt maturities coming out even a year from now, 2 years from now. And getting out in front of that today, understanding what it's worth today and what has to happen to make it worth more, I think is a key part of their diligence.
Right. What's the business plan? If we had to buy this building again today, which is essentially what you have to decide, what is the business plan other than...
Especially with now some more certainty around what's not going to happen with the rent loss. Right. So...
Do we see a flurry of activity in Q4, or do we see similar type of velocity over the last quarter?
I think velocity will increase. We're already starting to see it with the BOVs being increased because now there's some certainty around nothing's going to change short term, it seems like. And the people that were on the fence may have to make a tough decision to put more money in or just sell today. And that's kind of what I'm seeing and hearing out there.
And it's really interesting. It used to be, that the bank would provide almost a better option than the selling market. But today, we go into every pitch. We're like, the bank will appraise your building for $7 million. We believe we can get $8.5 million because we usually can. That's why they're only lending 55% LTV, because we're selling it at a higher valuation than what the bank's underwriting
We just
to.
can't
So,
get the bank to do the leverage.
so there's a big hole in the market with, the regional banks. I was talking to one person, that lived through 2008 to 2010. I was just starting out then, so I wasn't completely plugged in, but he said it was actually easier then because the regional banks were still kind of healthy. They were getting pumped with money by the federal government, and in the 50 million and under category, they were still able to refinance you, and rates were low. It was the bigger collateralized debt that didn't exist, in the GFC. But today, he's like, there's less regional banks, basically hardly any that are really that active, and the rates are really high. So he's like, this is almost worse from an operator standpoint of trying to refinance because there's no reprieve. It's like the money exists, it is out there, but it's very expensive.
Yeah, it's very expensive. And I always wonder, I drive around near my house and you see these kind of random regional banks. Who banks there?
Yes.
Who is putting their money in these random banks? But people do. And I'm curious to know if there's going to be any sort of further consolidation there. But the banks are really after the deposits. They want the deposits.
They can't lend more without them.
They can't lend more. So you're telling me I have to give you a bunch of money so you can lend it back to me at a higher rate? That's kind of what the conversation is like. They want 10%
of the loan amount in deposits.
It's wow.
So they're going to give you 55 to 60% LTV. I tell everybody, I'm like, if you don't have half the money of the purchase price, we got to end the discussion because they're going to give you 55 to 60% LTV, and they're going to require 10% of the loan amount in.
And their restrictions are getting even more, right? They're being more stringent. Yep.
Yeah. So this is fun times, guys.
So lots of headwinds, but lots of deals still?
Yes.
Yeah, lots
Spring
of deals.
2024 is my prediction when things are going to start to open up.
Why is it that long? I think it's going to be the winter when it gets cold out.
I think we still need there's still a little bit more pain.
I will have to plug Mike one time because he's been saying North Williamsburg is mini Soho and turning into Soho for years, and it's finally now.
I thought you said it's like meatpacking.
It's a mix.
It's a mix.
It's a mix.
Best of
It's
everything.
a blend.
But
The best of everything.
His prognostications have been visually confirmed. You have Hermes, Chanel, Google, all the tenants on
everywhere
North 6 and
everywhere
White.
you shop, right?
Yeah.
No, everywhere my wife shops.
That's it. All right, great guys.
Still can't get her to move that.
I'm broke. All right, guys. Well, we'll see you in 90 days, hopefully with a little bit more coin in our pockets. If you're out there listening and you are an LP that just wants to get hooked up with the right general partner but don't have operating experience but have money to put out and want to take advantage of some very attractive valuations, please reach out to us. We'll put you in touch with the best in class. If you're out there and we can be of any assistance in any way, let us know. Have a great quarter, guys.
Thank you. Take care, guys.